New York Federal Reserve data released in 2026 put a number on something that has been building quietly since the pandemic-era loan pause ended. 2.6 million federal student loan borrowers fell into default in the first quarter of this year alone, on top of roughly 1 million who defaulted in the last quarter of 2025. That brings the total to about 9 million Americans currently in default, holding $220 billion in loans, more than 13% of the entire federal student loan portfolio. That is a real number attached to a real government data release, not an estimate from an advocacy group with an angle. So is this a genuine crisis building in the background of the economy? Or a predictable, one-time bounce back after years of loans not being collected at all? Let us sort the signal from the noise. Walk through what actually changed. During the pandemic, federal student loan payments were paused for roughly 3.5 years. And during that pause, nobody could default, because nobody was required to pay. When the pause ended and repayment resumed, borrowers had to restart payments after years of not budgeting for them. On top of navigating a repayment plan landscape that has been in constant flux. Old plans getting phased out, new plans like the RAP replacing them, and a court fight over the SAVE plan that left millions of borrowers in a holding pattern. The delinquency rate, meaning payments more than 90 days overdue, rose to 10.3% of balances by early 2026, up from 9.6% just a few months earlier. Default is what happens after delinquency goes unresolved for around 270 days. So this quarter's default numbers are the pandemic pause finally working its way through the system. The demographic detail here matters more than the top-line number, because it changes who you would expect this to affect. According to the Fed data, older borrowers, residents of southern states, and people who were current on their loans before the pandemic pause began, meaning they were reliable payers previously, make up a disproportionate share of the new defaults. That is a meaningfully different story than young graduates struggling with entry-level salaries, which is the image most coverage of student debt defaults to. This looks more like a repayment system failure than an individual failure to plan. Borrowers who were doing fine, getting caught in plan transitions, paperwork confusion, and servicer backlogs they did not create and could not fully control. Southern states also tend to have lower average incomes and less generous state-level financial support programs, which compounds the exposure once federal payments resume. Before you treat this as proof the entire system is collapsing, a few things temper the number. Comparing this default wave directly to pre-pandemic years is not a clean apples to apples comparison, because the servicing rules, credit reporting timelines, and even which loans count as in default have all changed since 2020. Some of this quarter's spike reflects a backlog of loans finally being processed after years of administrative pause, not necessarily 2.6 million individual new financial collapses happening in a single quarter. It is also worth being clear that specific guidance on which repayment plan is right for your situation, whether to pursue income-driven repayment, forbearance, or something else, is not something this channel is qualified to tell you, and depends entirely on your individual loan type, income, and servicer. That is a conversation for your loan servicer or a certified student loan counselor. Not a video. This is not just a personal finance story. It ripples outward. Federal student loan default carries real consequences. Wage garnishment, tax refund seizure, and credit score damage that can lock people out of mortgages and car loans for years, which slows down consumer spending broadly when it happens at scale. 9 million people holding damaged credit is a drag on the exact kind of household spending that keeps the wider economy moving, from car sales to home purchases. It also puts pressure on the Department of Education's collection infrastructure, which was scaled down during the payment pause and is now processing a volume of cases it has not handled in years. If you are currently on a save plan or unsure which repayment plan you are on, checking your servicer account directly is the single most useful thing to do, since transition deadlines have real consequences attached to missing them. Quick recap: 2.6 million borrowers defaulted in the first quarter of 2026 alone, bringing the total to roughly 9 million Americans in default on $220 billion in federal loans, driven largely by the pandemic payment pause ending into a confusing repayment plan landscape, hitting previously reliable payers disproportionately hard. So, signal or noise? Signal. The scale is real, the government data behind it is solid, and the consequences for borrowers and the wider economy are not overstated. It is not, however, evidence of a brand new crisis appearing from nowhere. It is a predictable, delayed consequence of a multi-year pause finally clearing through the system. If you have a federal student loan, confirm your repayment plan status directly with your servicer this week. Subscribe for the economic numbers checked before they become talking points. Signal from the noise. Every week,